It really is a perfect storm, and it's not one theme, it's several, but they're all sort of marching toward one another, and it's gonna be pretty, by this time next year, I think that things will be very disorderly and people will know it.
Welcome to the Rose Show podcast. Welcome to the Rose Show. Today we go beyond the headlines and discuss what's really going on in the real estate market, a multi-trillion-dollar industry. And my special guest today is Melody Wright. You might have seen her on many podcasts. She has an amazing Substack, and she's like boots to the ground. She goes out there and sees what's really going on in the real estate out on the field. She's a strategist, writer, technologist, GFC1 survivor, and we're so grateful to have you here. How you doing, Melody?
I'm doing well, and thank you so much for having me. It's an honor.
Oh, it's an honor to have you here. I'm glad I was able to catch up with you. You're a busy woman. We're grateful to have you. And, we're going to expose some disinformation in the real estate market because there certainly is a lot of disinformation out there, and there are things that are hidden from the public. So I look forward to comparing and contrasting the headlines to what you're really seeing out there on the field. So Melody, tell us about your background. What is, besides your amazing Substack and your tweets and all your work, tell us what you do in your background leading up to now.
Yeah, so it's kind of a crazy story. I was a failed academic. And what I mean by that is that, I got my master's at NYU actually in English and American literature and went off to PhD school and realized this is just not for me. I'm the kind of person I love to learn things, but I'll learn, 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 learn. And then I'll kind of be like, okay, I'm done with that. I got to move on to the next thing. And in academia, you just get to talk about the same thing for the next 70 years. And I just had no interest in that. But I always worked while I was in school. Like when I was getting my master's, I also worked at the Wall Street Journal. So I was always doing, both things. I'm a jack of all trades or Jill or whatever, but I also am somebody that needs to be doing a whole bunch of different things at the same time or I'm going to be bored. But fast forward, I was a useful idiot. I took out, student loans. And I realized there was no way I was going to ever be able to pay those back on a professor if I ever got to be a professor, an adjunct salary. So I had to get a I had to get a job, and I fell into mortgage by complete accident. I had a lot of like project management experience, and so there was just this random project analyst job in Minneapolis where I was, and I just went in, and the guy said, "What made you want to work for a mortgage company?" And I said, "This is a mortgage company." I had no idea. I mean, and had never myself had a mortgage, and to this day, to be honest, I never have either. And so that was 2006 in September. And
Mm.
so I was in corporate FP&A or financial planning and analysis, which means you're very close to the executives, you're very close to what's happening because you're always doing analysis of different strategic, mergers, alternatives, whatever. And Cerberus Private Equity, you guys are First Key Homes. They own First Key Homes. You guys might know them. Had just recently purchased us, but they were sitting with us at our October party where balloons were coming from the sky and there was a big Lego house, realizing that the market had turned. And so they quickly wanted to have a purchase price adjustment, but not knowing really our business. I became their girl Friday to some extent, running around the company, getting management reports, just figuring out this business that I had no knowledge of. And I got a crash course that you really, it was because of the unique time. I just saw so much. And I think I'm a child of that time. And so suddenly what was happening because they wanted that purchase price adjustment, we were the first to start taking all of our write downs and no, just you'd walk in the office. Okay, we're writing down 800 million today. Okay, we're writing down a billion. I mean, it just was absolute crazy town. So you get all the way through that. And we are doing strategic alternatives, trying to figure out what we're going to do. We were a top 5 originator and servicer. We're the person you can't see in those movies Too Big to Fail. We were at those tables, but we were GMAC. We were later known as Ally. We were a subsidiary of GM. And so, we have a crazy story that a lot of people don't know. We kind of became a bank holding company overnight so we could receive TARP funds. And I was there in the GM building the day that that happened on the executive floor. We were either going to announce that earnings are bankruptcy or, this investment. So it was crazy, crazy times, and just went on from there to manage the crisis. Ultimately, got called in to help manage our bankruptcy. Was there for filing day one motions, and it was nuts because you were in the middle of everybody thought it was a subprime, these crazy actors, but in reality, like my company, we were Fannie Mae's top servicer. We did have those non-traditional products and we're a top subprime, but in reality we had a very big large government book as well, and the people that were in that book were the average Americans who had good credit, who when they took out their loan, had a decent loan to value or things like that. But in reality, you just saw over the years that credit quality degrade as people lost jobs due to the financial crisis. So a lot of people think subprime happened, everything blew up, and that's who went to foreclosure. The reality is subprime was the trigger from a collateral perspective, but that wouldn't have taken us down in any way, shape, form, or fashion. What happened is that your regular American, and I call them the forgotten American, started suffering under increased property taxes, insurance, similar to now, as well as prices were going down due to distress selling. But went on from there, helped sort of work on the projects for our regulatory nightmare that we all got into, Chase, all of us together, the big five, through what were called the consent orders, the AG settlement, where the DOJ signed a settlement with us, big five, on how we were going to operate in the future. And then we had penalties, there was testing, all kinds of craziness. So, just from there, when the auction went through at my company, I went out to several non-bank originators and servicers trying to get them. This was a new world, trying to get everybody up to speed. What I realized is there wasn't a lot of appetite for that to truly change the industry. So I went off to technology, did that during the COVID boom for the most part, although I had still a role in the origination market. But just kind of decided from there at one of those companies, I got asked, when will rates rise? Because that would have signaled everything turning. And that's really how I started diving back into macro. I used to study all of this quite in depth and did it for my graduate studies, but I kind of left it all behind. And so I kind of got myself reacquainted, read Danielle DiMartino's book Fed
Mm.
Up, and then got on Twitter because I couldn't find her anywhere else or afford her anywhere else at that time. She now has a product that people like me can afford. But at that time I had to get on Twitter. And really that's when I started really getting into that, the whole, what I would call FinTwit community or things like that. And I just realized there was a total lack of understanding of the housing market. I mean, total lack. And so I had to go because all these people seemed a lot smarter than me, had been doing this forever, had like all this crazy 800 years of data, which now I realize they really didn't, but whatever. That's when I said, well, I have to get out on the road because I can't prove it right now with a skill set that I have any other way. I've since, and at the same time, I had started tracking markets. I'm now up to 82 markets each week for inventory, for rent, for short-term rentals, for sales, home prices, all that kind of good stuff. But I've married those two things, the micro and the macro, to really try to give people an understanding what's going on. Because what happened to us during the GFC is that every month you thought things were turning around. Especially during the season, which we're in the season right now. But, my leaders were just so confused by what the economists out there were saying. And they made some really bad bets and some really bad decisions. And what I would love is that we never have to get there again, or that I could help educate people on what's really going on and how the mortgage and housing market actually works. Because I think most people have no concept. They don't know that, most of it is government backed and they're actually buying their loan is owned by the government. So there's just and the secondary like securitization markets, a lot of complicated financial stuff. And so I just really want to get that information out to everybody. And I'm sorry that was really long, but I was just trying to go as fast as possible um, to just give you kind of the nutshell of how I got from there to here.
Love it. That was awesome. That was a great walkthrough. You have so much experience, having experienced that from that side, the inside of that. And then now coming to us and just telling us what's really going on, not only with your knowledge and experience, but you're out there on the field right now and you're able to compare what you're seeing to what happened in the past in 2008. And, there's a big difference between leading and lagging indicators. And a lot of these economic data we see tends to be more lagging. So by you looking out there, talking to people, seeing the sentiment, which is a leading indicator, it's more of a soft data, you're able to tell us things before they actually happen. At the heart of every crisis is debt, over leveraging. And, when we had ZERP, and Danielle was on the show twice, and we always talk about how ZERP was what ruined everything. And that's what causes a lot of the malinvestments, over leveraging for people. So that seems to be the root of everything. And, I want to just get started with GFC one survivor and the meaning of that, because we're going to be comparing 2008 to now, and I want you to break it down for us. Now, World War One was only called World War One after World War Two happened. So you're saying GFC one. Tell us about that and what you're seeing out there and how it compares to 2008. And could we actually have a repeat or a close rhyme of 2008?
Yeah. So I think, for me, coming from within the industry, 2 years ago, I would have told you we would never see that kind of trouble again within mortgage. We would never see that kind of trouble or speculation again in housing. Um, but and honestly, I kind of believed the narrative because I had been one of the people who worked on the policies and procedures, who made sure that, all of these different things were implemented, and it seemed like everybody was on board. But I should have really been looking at my own experience as I went out to the non-bank originators and servicers. They didn't have the appetite to really follow it through. So, but I'll tell you that I really didn't think there would be an issue in mortgage. But what I came to understand after, hours of study, and I'm a big fan of Eurodollar University. I don't know if you've ever had Jeff Snyder or Emil Kalinowski on, but they talk a lot about the back end of the system, the collateral, the money that's flowing through the system, and the shadow markets, and the way, they really helped me. I knew my own experience of what the GFC was, but I didn't understand that back side of it. I mean, I knew we had crazy derivatives. I knew we had CDOs. I got to talk to BlackRock at 3 a.m. in the morning being like, we don't have $130 million asset here. This is worth zero. So all of that I knew from working there, going through that. But what I didn't understand what was happening in the back end of the system as people were rehypothecating. And in reality, until the Big Short came out, there wasn't language for what had really happened. I think that movie gave us, a lot of people that were in the industry, a way to frame our experience that we really didn't have before that, in terms of how big it was. And so I think, then I started watching Eurodollar University and realizing, oh my gosh, like nothing has really changed. The shadow markets are much bigger than they were, and we are still rehypothecating. Which is basically, I'm going to lend this money to you, and I'm going to lend the same money to you, and I'm going to lend the same money to you. And talking about that leverage you're talking about in the system. And that's why, suddenly this past week we got that announcement, oh, there's something wrong with the living wills, for the big banks. And that makes me laugh because, having been on the forefront of the first time those things were ever required, the first time a stress test ever happened. I mean, those were some crazy days. We all just learned how to pass those tests. We learned what was supposed, everything was just became check the box. And so for them to come out and say that there's some issues means we're being prepared for something, because there have been no issues for a really long time and nothing much has actually changed. So there's an issue now. It's been an issue for a very long time. And so that's ultimately, through my study, what I realize is that nothing has changed. None of that speculation is still happening. And in fact, it's just gotten much worse and much bigger. And of course, we know no one went to jail, and it's just the same recycled actors who learned that they could get away with it, and they just kept doing it. Cerberus got bailed out, and so they went on and continued to do the same old thing. And so that is why I believe that we are gearing up for a credit event. It won't be exactly like the last time, but you're just starting to see, in my opinion, stress in the system. And I think that that is, and if that does happen, and we're seeing it not just here in the United States, but across the world, just, issues in different economies. And honestly, something that, like what's happening with the bank, with Japan right now, or even what's happening with autos, because they're very deep in the attack, cyber attack on the auto industry. That could create a credit event, because they're so heavy in the securitization markets, and those markets are very much part and parcel of this. And so that's a long answer of, we absolutely can have it one again. I believe we're setting up for one. I believe that really the train has left the station. And so, that's why I say GFC one, but I don't say it lightly. It took me a long time to get there. But it's, through a lot of study and then just looking with my own eyes.
Thank you for that. Um, it's like a money merry-go-round, like you mentioned. It's like the money just goes around and round, and the fractional reserve banking, we have multipliers on this money. 83% of the money that's created is from lending. Fiat system is based on a debt system. I want to just start with the mortgage side of it before we get into the fun stuff out in the field. What are you seeing inside the mortgage world of what's going on right now? Now, everyone talks about GFC 2008, 2009 was more of a banking issue than just housing issue. And it was the MBS, the CDOs, and those being repackaged. What are you seeing now inside the mortgage world that resembles that and that are red flags to you?
The biggest, so I still oversee client books, so I look there, but I also look at Black Knight and Inside Mortgage Finance and a whole bunch of other sources. And my number one concern, I've actually been talking about for a year and it hasn't gotten any better and it's just getting worse, is FHA. And FHA right now, which used to be a smaller portion of the market, it was a program that used to be geared to first time home buyers. It has gone completely off the rails. And essentially, as in terms of mortgages outstanding, it's doubled since the GFC. And the problem, we have an 11% delinquency. So 1 in 10 borrowers of FHA are delinquent right now. Okay, people are like, well, we have all these government programs. The problem with that is that's after all of the government programs. So if you think about FHA specifically, they had the forbearance, 18 months you didn't have to pay. You could then do a partial claim to put it at that whole balance at the back of your loan, only to be paid off when you pay off the loan or sold your house. Or you could do a combination partial claim plus a 40-year modification, which seeing those just make me ill. But because when you look at those amortization schedules, it should be criminal. But that hasn't even stopped this delinquency. Additionally, what most people don't know is that all of the agencies like FHA, Fannie Mae, Freddie Mac do these things called single family loan sales, where they sell off the delinquent mortgages to private equity, to hedge funds, to sometimes nonprofits backed by hedge funds, whatever. But some of them are real nonprofits, but not not a ton of who's playing in this space. And then those become non-government loans. And so in reality, FHA should not be looking like this. None of the GSC loans should be looking like this. And so I think that what's happened right now is that if you remember from the Big Short, where they're like, what does the ABX say, which was the subprime, indicator. I think at the time they said it's at 5 or something like that. Right now, delinquency looks historically low because everybody's looking at the wrong thing. The Fed
Mm.
schedule is for commercial banks only. We know that since the GFC and because of Basel III, the non-banks have become the biggest players of that space and just recently completely overtook it, with the majority, a slight one, but majority of the mortgage space. And so if you look at the Fed or Fred schedule, that's not going to tell you a daggum thing. What we will see is that we're at the same place we were at in Q3 of 2006 from a delinquency perspective. If you go look at Inside Mortgage Finance, they track a whole bunch of different players in the space. If you look at the banks, they track right along with what that Fred schedule says. But that doesn't tell you what the non-banks do. They list some of that delinquency, but not a lot of players. Then you go over to Black Knight, who says they have 80% of all mortgages on their system. I question that now based on some things I've seen, but their delinquency also looks really low. But I can go back to Inside Mortgage Finance and look at these specialty servicers that I know aren't on Black Knight's system with much higher delinquency. So I believe we are already in a delinquency spot that would be troubling if we could see it, but we can't, because in addition to this regulated market, we also have this private note sale market that has cropped up, and it's much bigger than most are thinking. So in my client books, which are focused on government product, we are definitely seeing people delinquency get sticky. They're not curing. And so we had with tax and bonus season, things got a tiny bit better, but they're starting to degrade again. And what you've got your people that are 90 plus delinquents getting swooped up by whatever programs are still out there. And there are still plenty, but they get put on hold. And so it doesn't look that bad, or they get into a program. But I think by this time last year, or this time next year, we're going to see some serious delinquency materialize. So that's kind of, and again, I'll just repeat that thing. What's happening is a lot of times you roll to that 30 plus delinquency and then you roll right back out. You get caught up. What's happening is people are rolling forward now. It's sticking. And so, and it's hard to see because Black Knight's not going to tell you, they're going to give you part of that picture. And sorry, the most concerning thing is that the highest delinquency is in the 21 and 22 vintages.
This is very interesting, Melody.
Right.
I mean, this is something no one's talking about. I mean, when you go and you read around about real estate, they're like, foreclosure rates are low. They're at their lowest right now. There's no danger out there. But see, you're looking at other data that it seems like they're hiding it. Are they hiding this data?
I
Is
don't
this
think they have to hide it. It's just nobody knows where it is. You know what I mean? It's so complicated. I mean, sure, I think they frame it as if, because they
Mhm.
have the vested interest, and maybe there are some bad actors that are hiding it. But and ICE owns Black Knight. Who else does ICE own? The New York Stock Exchange. They also just kind of took over the origination technology side. So there are definitely vested interests. Don't get me wrong. But I think this stuff is so complicated. It's just very difficult to find it. And due to the bad technology in this industry, which sometimes I do believe is on purpose, I mean, nobody has this information.
Well, we do now with you, Melody, so we're grateful for that. So these non-banks private note sale markets, what is causing, in your opinion, these delinquencies to be rising? Are these people locked into these low rates? Are they losing their job? Is it just inflation and hardship?
I think for the folks that have probably, I mean, I think it's inflation. I think it's hardship. I think it's the fact that, I mean, I'm sure you talk about this, but, our labor market has been weak. And
Yes.
I'm personally of the opinion that we have been in a silent depression, which is Emil Kalinowski's term from 2007, that something broke. All of our trend lines broke. We have all these missing people from the workforce. We have all these missing men from the workforce. And people may say, well, maybe they're taking care of kids. That's not what the data has borne out. And the problem is that we are just not producing like we used to produce. And I think that a lot of that has to do with companies are no longer interested in investing in productivity, investing in, research and development. They're only interested in buybacks and, and making sure that their stock price looks good. And anybody who's been in corporate America they will tell you that by just telling you their story. So, I think that that's a lot of it, that it has been very important in mainstream media to pretend like things got better, and that all this policy worked, all that quantitative easing worked, all that these shenanigans, ZERP. But in reality, sure, we had more service jobs. We had more, you could go get a job at Chick-fil-A, or you could go get, but you could not go get a job or career that was going to sustain the American dream. And I think that this has been going on way longer than, most folks want to admit or recognize, because it's been more politically palatable to say, in 2018, for instance, jobs, it's great, it's booming. But when you have to have multiple jobs, that's not the American dream. I think most of us grew up wanting to obtain.
Well said, absolutely. We have higher fees, higher property taxes, higher insurance, like we mentioned earlier. Small businesses are strapped. When we look at the small business report, we see the sentiment is at the low, so low. A lot of uncertainty going forward, and these businesses aren't reinvesting in their businesses. There's a lot of uncertainty for future growth. So yes, they do buybacks, these corporations, because they want to prop up their stock prices. Regarding the labor market, yeah, the labor participation rate is lower than pre-COVID. I mean, it's
Right.
really low, and they're revising lower across the
Right.
board and all the economic data. They try to hide
Right.
it. They try to be very sneaky about it, and they keep revising lower. And yes, the actual numbers that came back, we had a few economists on here. Dr. EJ Anthony was great, and he always talks
Oh,
about,
yeah.
right? He's great. And
Yeah.
he always talks about how, they came back and the jobs were much less than what they reported on paper. Plus, we know it's big government, a lot of government jobs as well. So, and
Right.
when you look at GDP, if you remove the government spending that's bloating it, it's probably much lower. And so there's a lot of
Absolutely.
hardship going on right now. And I
I
agree with
agree.
you. I think, it doesn't matter how low your interest rate is on your mortgage. If you lose your job, you can't pay, right? And
Right.
if your investment property doesn't cash flow, like the Airbnb, you're not going to be able to hold on to it for that long.
A
So,
hundred.
yeah, absolutely. Well said. I think we're all in the same camp there with our thinking. So, I want to go into where you've been recently and what you're seeing out there on the field. Now, we know real estate's very regional and it's a very slow moving market. So, could you tell us where you've been recently and what you're seeing out there? And I'd love to hear about this shadow inventory and all this new supply that could flood the market.
Yeah, yeah. So I did my first trip in January of 23, and I actually just recently went back to Austin. And what I can say is that I think that we probably, like gnats, have a very not a good understanding of time, if that makes sense. And I think, when I was first out there in January of 23, I was like, oh my, I mean, it was mind-boggling, all the inventory. I couldn't find it listed anywhere, but I had to come back and I had to see, okay, is it because of the stage of construction? Is it because of this, and this that I'm seeing this picture? But so recently I went back and I went with Travis from Real Estate Mindset, and we did a lot of drone footage of Texas and San Antonio, Austin, and Dallas. And, for those that have been to San Antonio or Austin, you can go to the south of San Antonio, all the way very far north to Austin, and all around this huge perimeter, and it's just one big new build site. I mean, it is just, and I don't care if most of Mexico moves there. I mean, that's how much is being built out there, and it is insanity, and it's just hard if you haven't seen it. It's hard to explain, but these trips can be very depressing, because every time you look at one of those empty homes, you're looking at somebody's finances. You're looking at a bankruptcy, basically, because I mean, so many of these homes are not going to be filled in the near term, or if ever. And then people are going to argue and say, well, no, there's a great job market in San Antonio, for instance. there are still too many homes. The existing neighborhoods are getting sucked dry because the new builds with their incentives are pulling them out to the suburbs. And so, it's now this big battle. And, prior to that big trip to Texas, we kind of went up the East Coast to South Carolina, North Carolina, Charlotte, and Atlanta, and it's just as bad there. And South Carolina is in for some serious trouble. But you see a lot of things like they try to pretend. My favorite, so something I used to talk a lot about right after my first trips was called salting the lots. And what they do is they try to make it look like everything's sold. And so they'll park all the construction cars will park in the driveways. They'll pull the garbage cans down to the front. You might even see wreaths on doors, but if you go at night, nobody's living there. Um, so I saw this all the time, but of course I couldn't prove it. I would talk to sales managers that would tell me that it was happening. You'd have green sold signs for what was really sold, red sold signs for what wasn't sold. Well, when we were in Austin, we went to this abandoned new build community. Okay, that shouldn't be happening right now. These things were almost complete. Copper, there were some appliance. I mean, this thing, well, there weren't any appliances left, but you could see that there had been some. And there were sold signs in front of everyone, and they were so abandoned. There's like flapping, blue stuff in the wind. No one was there. The site was completely abandoned. We did research, realize it, but that just shows you that there's a lot of tricks out there to try to make you think that something's sold when it's not sold. And that's what happens a lot of times in these new builds. And then they don't list them. You can go to any of the sites, Realtor, Zillow, even New Home Source, and you can look at which New Home Source. I recommend it for anyone just to get a sense of inventory in their city, as you will probably be surprised. It's just a website where you track new home builds, but you can bring that map up and you can go out and in your car and see that they are woefully, underrepresented. And so we just honestly, based on everything that I've seen, we probably have 4 times the inventory that we're seeing that being listed out there right now. And there could be a variety of reasons for that, but that is really what I believe on the new home source, our new home site side of things. And then you kind of mentioned the private note side, which I can go into, but I want to stop there to see if you have any questions on the new home stuff.
Absolutely. Well, let's go into these home builders and what's really going on here. So they're building these homes and they're just sitting there empty, and they're not fully, well, they don't have appliances, but they're complete, and they're just sitting there empty, and they're pretending that they're sold. But what's going on? How are they getting compensated? Aren't they losing money by just holding that asset?
Well, in that situation, that company is now in bankruptcy. When it
Oh.
comes to the larger builders, though, it is a leverage game. And, it's all about, do I have a funding facility where my interest is lower than the loans that I'm giving out? Because all of them have mortgage arms. And so if you have that mortgage arm and you have access to the capital markets through securitization, by selling your loans to Fannie Freddie, which they all do, then you can keep the game going. The other thing that builders have been doing is these buy downs where, if you think about it, they keep that money, they don't pay it out all at once. They keep it in an escrow account and advance it. And so they can earn what we're all earning in money market funds and on treasuries and things like that for now, But when their facilities run out, because a lot of them need to be renegotiated, are expiring, things like that, we're seeing in the industry that those big lines of credits are getting reduced. And so it's just a leverage game. It takes time. And I think last year was, you had the entire media, you had Connor Sun from Bloomberg come out and say, you should go get a new build since there are no existing homes, and they're going to give you a whole bunch of incentives. And I think the entire new home market was kind of propped up on that narrative, after we all realized that they were going to put on their capes again and everybody was going to be saved during the banking crisis. I think that was a signal that, it's back on. And I think that propped up the new home market because there wasn't enough existing inventory out there. But what happened is these things come into balance or closer into balance. And in markets like Florida, where you had all of that speculative building while you still already had existing, second homes, short-term rental people coming at buying everything that you can, and you had all of your big Wall Street landlords come in after the last crisis to buy up all that long-term rental. It looked like an inventory crisis. In reality, it was a misallocation of inventory, which got, all those short-term rentals for a minute got filled because everybody was going on big vacations during COVID with their whole families. So that made sense. The long-term rentals after Ian, there were a lot of people that needed to rent a home while their home was actually being, repaired. That's all ending, and we're all starting to go back to our regular patterns of vacation, and we just don't need that much supply. And so Florida turned faster in this selling season, where you started to see inventory flying to the markets, and because of that you started to see price reductions. And at the same time, so you had existing and new home inventory all hit at the same time. So, it really is a perfect storm, and it's not one theme, it's several, but they're all sort of marching toward one another, and it's going to be pretty by this year, next year, I think that things will be very disorderly and people will know it. So,
Wow. Wow. Well, it's always about supply and demand. And, I
correct.
always say about it's the rates affect the supply and demand, which is what causes the issues and the pricing and so forth. So now you went to Texas and now you're seeing Florida and this inventory. I was in Florida last year for a conference, and I remember being in Gainesville, University of Florida, my alma mater for my undergraduate, and there was so much new build. I mean, I was like, there are not even that many kids that go to school here. They're building everywhere into the swamplands. Are these centralized mainly around the COVID hotspots where people ran off to, or is it just widespread?
I think everywhere there is undeveloped land within, a proximity to humans, you will find at least one example of this. Here in Johnson City, where I live, you're familiar with, they're all over. They're all over. Not like you saw probably in Gainesville where they're all clustered, like you saw these, what I would call these big mega sites. That's what I've seen all over. The first time I saw one of those, I was blown away. And that's where multiple builders build in one site. They're not like that. But if you look around the map of Johnson City, they're hiding off out, and it's just most bizarre. There's one that I used to have to pass to go get my mom, and there'd be this lone little girl like out at the bus stop, and there was nobody else in this subdivision full of empty homes. And so, are there places that are going to be impacted far worse? Absolutely. But I guarantee you will be able to find one of these in your backyard somewhere. But Phoenix, I was there in, you know, January of 23. I mean, that place is just, I mean, and that there's so much built to rent. There's so much multifamily. There is so much vested interest there. We haven't even begun to see that inventory come online. And then there are things like outside the city where they just had to close an entire new build subdivision because they didn't have the groundwater. I mean, but even right now, you can go out to West Phoenix and you can see signs for neighborhoods and you can see swing sets, but the grass is growing and there's no development because they were kind of stopped. Now some of those might have gotten restarted because a bunch of this game, as you said, this is all leveraging in the confidence game, right? And so I think after last March, people regained that confidence and they restarted everything. But Phoenix is one, as well as Las Vegas. They are both so overbuilt. It's insane.
Absolutely. I know I was in Scottsdale earlier this year and the prices were so high. It was ridiculous. And I think now there's more homes on the market. They're not selling at those high prices. So they'll probably start trickling down. But yeah, the prices were crazy, and the rental market as well. It was like 10,000 a month for this, 10,000, like what? And so are you seeing on the rental side as well that prices are elevated?
Absolutely. Oh, they're absolutely elevated. But I do think that in many places they're starting to come down. The problem is, and okay, is it when you're looking at multifamily, your audience may appreciate this, but RealPage, they're under that DOJ investigation for price
Mhm.
fixing on
Yeah.
all these multifamily apartments. That's Phoenix. All those people were using that. And so I watched, I studied my cities on RealPage for over a year, saw nothing, like no price move. It was crazy, even though the dynamics were changing. But then I could go to other sites and see it happening. But a lot of times, why I think rent prices are staying sticky right now, and yes, they did increase like crazy, but that rate of change is now slow. There, it's all slowing very quickly, and I do believe we'll see, deflation there in rent prices. But it's the new leases that I think what's happening. It's very similar to the housing market. As I talk to landlords, they may have 50 people apply, but only one qualifies. And so they're still not getting the occupancy they need because they don't have qualified renters. And of course, that's because of the prices. I mean, and then just I'm sure all of as after the GFC, I think, everybody got a little hurt in their credit, got hurt, from job losses, things like that. I think after this period, again, we're all going to have some wounds from this time that we'll have to work to repair.
Absolutely. It will take time, as it always does, but we will be better eventually, because that's just looking at history.
Exactly.
And we go through it's just the economic cycles.
Right.
So tell us about the private note sale market and what you're seeing over there.
Yeah. So, when you talk to realtors and you talk to people from within the industry, they'll tell you this doesn't exist.
Hmm.
But then I heard whispers about it at a broker conference in Las Vegas last year. And then I started every article about the housing market in Bloomberg or Wall Street Journal would reference what I knew would be a private note sale. And they can take on a variety of forms. One of those forms is seller financing. And what does that mean? That means like maybe I have a couple of houses. I want to sell my house to you, but you consult, you don't have your income's kind of, all over the place. And so I just say, I know you're good for it. I know your money good.
Mhm.
I'm going to lend this out under certain terms. And maybe I tell you, you have to be responsible in that contract for all the maintenance. Well, that was a $28 billion industry last year, that we know of, because that was what was in MLS. I think it was much bigger because I can tell from these news stories, talking to people, this is a much bigger market, especially in those places on Long Island, in these higher tier markets out in California. And so that was one component. And then I started seeing these crazy contracts people would send to me. And I'm like, what is this? And I heard about this thing called sub two, or and this is where you go in and everybody was doing this because they learned it from Wall Street. Is you go in and you can search if a notice of default or something has been filed at the county on a house. You can actually pay for a service that's going to give you all those listings plus everybody's phone number. Think of those signs: we buy houses, we buy ugly houses,
Mhm.
etc. And so they're going to see that you're behind on your mortgage and they're going to call you up and they're going to say, and just think about how profitable this probably was during the COVID forbearance, because before they were on the forbearance, they were behind, right? And so that person's going to say, hey, you know what? You're behind, but I'm going to take over your mortgage. I'm going to pay your mortgage. And we've got some options we can discuss. One, you can stay in the home, and we can arrange some kind of financing deal between the two of us. Or I'm going to find an investor to pay off that loan and I'm going to pay you back your equity. Or I'm going to give you cash for keys, meaning I'll give you 10 grand to go relocate. And so this market, no one knows how big it is because the mortgage company doesn't know it's happening. A lot of times these sub two guys aren't recording the mortgage deed because there's a clause in those deeds where if the mortgage company found out, they could make everything due and owing. The problem with these, though, is that the borrower is still on the note until that loan is paid off. And so an investor could walk away and the borrower is stuck and will go to foreclosure. They'll get the credit hit. So that's a crazy part of the market. How big is it? Well, the Facebook group is about 13,000 people, the biggest one, so this isn't small. It isn't insignificant. And then the other form this took was those single family loan sales I told you all about. I worked on dozens of those. Silly me thought that because there were so many restrictions on them, like you couldn't go to foreclosure, you had to offer certain type of workouts, you couldn't go to foreclosure for a period of time. I just assumed they wouldn't be able to resell them. But in reality, what they were doing is they were buying them and then they go find a private investor, a lot of which are backed by sovereign wealth funds or things like that, and say, hey, these 50 of the 2,000 I bought don't fit in my wheelhouse. Do you want them? And then they would sell them off into the private marketplace. None of this is being tracked. Like the reporting would come back that when they were doing the reporting up through HUD, it would come back as if nothing had changed. And so there's no traditional way to track this. And I think honestly, what's happened is that through the advent, of course, of social media, that, NAR and the MLS and things like this just started to lose relevance. And so as I think a lot of people still don't know that the way we understand inventory from Fred, where everybody pulls that number, realtor.com supplies that. That's from realtor.com. That is run, and that company is owned by the same company that owns the Wall Street Journal. And so there is just a ton of vested interest in this space. And I think, NAR is one of the largest lobbying groups by spend. I think this has been more a con in terms of they were losing relevance and they wanted us to think this was a story about something else altogether. And I think we'll figure that out in 5 years, but it's going to take a really long time for people not to believe this isn't about a housing shortage.
Wow. Yeah, because that's what they always say is a housing shortage. Now, NAR, you mentioned them. So let's just talk about their pattern. Sales are down, prices are up. And they always do it nationally, and they break it down to different parts of the country as well. But overall, that seems to be the pattern. What are your thoughts on what you're seeing out there? Are prices coming down? It's the most unaffordable market in, I think, over 40 years. Are prices coming down?
In some cities. And so you mentioned earlier, and I totally agree with you that real estate is local. What I do often say though is until it's not. And so we have big markets that when that narrative changes in those markets, the market narrative tends to change. And we're all borrowing off the same interest rate as well, depending on our what we qualify for. But yes, there are absolutely markets where, and I'll just, if I can give you some that
That'd be
where
great.
where sales are up and prices are down year over
Mhm.
year. So to me, that says motivated selling. Sales are up,
Yes.
prices down. Rochester, New York,
Mhm.
Carlsbad, California, Minneapolis, Portland, Costa Mesa, Orlando, Newport Beach, California, Ventura, California, Washington, D.C., Nashville, Chicago, Tucson, Scottsdale, Sevierville, Boca Raton, Florida, Miami, West Palm Beach, and Destin. So those are not just Florida. Those are in California. Those are on
Mhm.
the East Coast. Those are
Luxury places as well.
very much luxury places, which I think points to something you and I were discussing before the show. And that's
Mhm.
just these frozen luxury are super prime markets, which probably about 8 months ago, I started noticing the top listings were all of these $1 million homes. And I think that the super prime is coming under stress because they're the ones who were these limited partners in these multifamily deals where they put in their life savings, they put in bukus of money to be told right now you're not getting any return on that. In fact, there's a capital call, you need to give me another check, or by the way, it was just fraud altogether and goodbye, your money's gone. So I think that we're seeing stress at the bottom of the K and at the top of the K. And I think that the middle is starting to feel it. And I think you might have seen the, University of Michigan Consumer
Hmm.
Sentiment Survey, where the lower class and middle class started to realign in terms of that negative sentiment. So um, I think fundamentals are shifting, and I do believe that, more and more folks are actually coming under stress. But yeah, this is the thing. You can talk about a market in aggregate without a lot of detail and no history. By the way, National Association of Realtor, or NAR, they pulled history because they provide the inventory numbers. That all got pulled down off of Fred, and you would have had to pay $1,500 to get it. Luckily, a follower, gave it the data to me. But this is, I mean, everything is kind of, you asked, is it being hidden on purpose? I think they're just maybe, but it's, whether or not, we still don't have access to the data. Not your regular person does not have access to this data.
And then the Airbnb, a lot of them are very vacant. And even though they say, oh, they're being rented, it's almost like they're covering up for that as well. But there are a lot of vacancies, and we're seeing some prices coming down. And I believe there was a lot of creative refinancing that went on. Are you familiar with that
Oh yeah.
phenomenon?
Yeah, oh yeah. And that's part of that private note space. And where what a lot of these Airbnb bros would do is they'd lend between each other or sell to each other to get a higher valuation. So that person could then walk in the next day to one of these non-QM or qualified mortgage companies and get a refi. And the technology there also led them astray because there were these really, not well done technologies that were supposed to give you your average daily rate or your return on investment. And a lot of the lenders out there were using them to figure this out. But this technology would do things like a comp was within 10-mile radius. Imagine that in New York City. I mean, that's not even, I mean, that's like 10 universes, you know what I mean? And so I think that the technologies that were created and never finished in this space really did a disservice to a lot of folks as well.
Absolutely. So let's talk about timeline. You can give us a rough estimate, just so that our audience and everyone can put this in their minds.
Yeah.
Right now, like we talked about where I live here on Long Island, our market seems to be stuck, and there's just historical low inventory. Nothing's really moving. Prices are elevated, not that they're selling. They're staying on the market a long time. When do you think, I know you keep saying maybe a year from now, we're going to see a real change, some disorderly. When do you think we'll start seeing the market moving and prices coming down where people can start saying, oh, maybe this could be a good time to start looking to buy
Right.
something at a more reasonable level? What are your thoughts on that?
Yeah. So I'll give you kind of my forecast right now,
Yes,
which,
thank you.
is, barring an exogenous event, barring us going to war, things of that nature that could
Hmm.
really change this dynamic. I believe we are about to round the corner, and we will start to see price declines. Nothing crazy. What I see is by the end of the year, probably like a 5% aggregate decline that might become evident in the spring of next year. But 2025 is when I believe that things will start to get really disorderly because of, leverage expiring, not being able to refinance, because of more job loss, because of all this inventory coming online. And so that is the year what I see over the next 5 years, the largest price decline. I see a few more years of small price declines after that as we continue to correct downward. But that really is, I think that 2025 is going to be the worst of it. But what I would tell people who are looking is, if you know where you want to look, go there, drive around the streets, go to the coffee shops, talk to people. And I know this seems crazy, but Zillow, Realtor, Redfin, these are not your friends.
Mm.
Everything is about getting your data. Number one, they want your data. That's what they want more than anything. And then also creating FOMO. Zillow does this thing where their default filter is coming soon properties, which are not the ones that you're probably going to be able to buy. So my whole point is the system is rigged against you as a consumer. So you do need to do that boots on the ground research, or, reach out on to me, ask me questions. But honestly, nothing is better than going out and look and then talking to people. And you might find for sale signs at houses that aren't showing up on Zillow and Realtor and others. And and I believe this is happening in every neighborhood. And what I tell people is go drive at night. And that will tell you everything you need to know about, because a lot of these homes that look like they're being like a minor repair, they're actually a fix and flip. A lot of these homes that look like maybe they're away, actually, that's not true. There's some investment company owns them, and maybe they're sitting in a bankruptcy. If you don't have the skills that I do to go look in the bankruptcy courts, go look at public records, you're never going to know that. But with all of this distress around, these multifamily LPs and different things like that, that that is all happening right now. And in many neighborhoods, what I'm hearing from all over social media right now is I had no signs in my neighborhood yesterday. I have 4 signs in my neighborhood today.
Yeah, it happens very fast. So it's very important to be aware and check out all these other sites. Don't rely on Zillow and Realtor.com. Agree with you completely. Now, multifamily, we've mentioned it a lot. I want you to tell us about what you're seeing with the inventory in multifamily. Now, I've been hearing a lot of foreclosures going on in that market. Commercial real estate's being hit with office and vacancies up historical highs, since COVID and the way people work. But what are you seeing in multifamily?
Uh, so Nashville, back last year, I saw something that reminded me very similar to Evergrande. I can't find it again, but just put it doesn't matter. Nashville, wherever, huge, massive multifamily buildings, complexes, farms that are completely empty. Charlotte has a ton of this stuff. This one area that was an old farm, it's all multifamily. There's no one there. Like it is, it's crazy. And everybody will call you crazy. I'm sure some of your viewers will think I'm crazy, but you just have to drive around and see it. And a lot of this, because it was taking longer to build things, people just kept filing permits. And I think they just didn't realize there were 8 buildings just like it going up around the corner. And so now, where you already have elevated vacancy, like Phoenix, Austin, Dallas, Houston, San Antonio, Charlotte, Nashville, Atlanta, you've got all of this multifamily coming online. At the same time, you have all of these new builds, which include build to rent. And you will also see boomers letting go of their second properties. So you've just got all of this happening at once, but multifamily is just out of control. Of course, you probably know, but the most since the 70s. And honestly, we don't have the demographics to support it. We've stopped having babies as often and as much. And even people at this juncture always say, well, what about immigration? I say they're already here. They're already here. And maybe they're staying in hotels in New York, but those will get converted off of some government grant of, commercial to residential. I mean, there is space already. And that is not a view on immigration. That is just in terms of a number perspective, we have the inventory. We are in an oversupply situation. It's just that it's not affordable. It's simply not affordable, or it's being taken off market for investment schemes that will never pan out.
Yes, like a Ponzi scheme. It's just unfortunate that people have to suffer at the end. It's Main
Exactly.
Street that suffers. Very, very important to look at all elements of real estate and supply. It's always about inventory and supply. When you have all this supply that could potentially happen really fast that it comes to the market, there's a lot of disorderliness, as you said, that can occur into 2025. There was a report, you tweeted about it, and I read about it. The NAR and the census talked about how existing home prices are higher than new homes. And that's big news. And I love your tweet that said in the last 25 years, June 2005 and June 2021 are the only other times that you've seen this occur. And you said in your tweet, beware existing home sellers. My thoughts are that those prices of existing homes are going to probably come down to match the new homes, not that new homes are going to go back up. Tell us your thoughts.
Well, and so seasonally, new homes peak in April. And so that price and that's a 25-year seasonal arc, but that's not even my point. What the point is, builders are not like existing home sellers. We're a bunch of individuals that might have a whole bunch of different things we can do that may, and we might have some time on our hands. Builders are manufacturers. They have to push that product out that's sitting on a warehouse facility line of credit. They have got to get it out there. Plus, they're also making promises to the street about deliveries. And so what will the builders do? They'll give more and more incentives. You can already see them saying that in the builder survey results. We've got them already, their confidence survey. They made more price reductions. They did incentive percentage went up. And so honestly, what's going to happen here is that the builders are going to cut the existing homeowners and cut them aggressively because they need to bring them, they have got to move that product. So I agree with you. We've never seen it stay like this. It flips back the next month. I have a sneaking suspicion we may see it persist for 2 months because June is actually typically the existing home market price high. But either way, that's going to tell us a lot about where we are in the market. But June of 05 and June of 2021 were very bubblicious, as we know. So this tells us that there's something in the market that is not working the way that it's supposed to.
It's unsustainable.
Correct.
You say,
Yes.
right? It's an
Yeah.
unsustainable phenomenon.
Yes.
And
Yes.
yeah, wow. So where to next? I want to know about your travels, where you're headed to. Anything in the Pacific Northwest or in the Midwest, anywhere new that you're going, or any repeat places that you're visiting?
Yeah, so there's a lot. I do want to get out to the Pacific Northwest. It's just such a trip. I think I probably will make it back down to. I spent 2 months in Florida last year, this time, and I'll probably make it down to Florida before fall, to get some drone footage down there of places like Lakewood Ranch, which are just farm isn't even the words, city of new builds that are, empty and boy, are there some vested interest down there. But probably back down to Florida just because, we exited the season in Florida in April. And so, there's still plenty of inventory. The growth of that is decelerating a little bit as it should because we're out of its season, but it is still staying high. And I have a feeling by next spring selling season, I mean, it's gonna be a nightmare down there. And I just hope and pray honestly that we don't have a hurricane this year because Fort Myers, it's just so sad to see, and just for sale signs everywhere you go, because the insurance crisis. Even if you did want to buy, you can't afford your insurance or your property taxes at this point.
Very true. There was an article that came out about condos in Florida, how
Oh yes,
insurance, you saw that one, right? Insurance is up insane amounts. And then last year when I was in Florida, when I was through Gainesville, I went to Volcano Beach in St. Augustine area, and they were hit by a hurricane as well. And property values there were slashed. I mean, there were homes that were destroyed. They were just sitting there. And it was just so sad. I lived through Hurricane Andrew, which dates me 93, 92, 92 was fall 92. And I lived down in South Florida. And, it's so sad. So my heart goes out for all the hurricane victims out there. So we hope it's a mild year this year. It's the last thing they need after all these higher prices and
absolutely.
insurance and everything. I want to talk about the Fed before we end up. This has been amazing with you. You're amazing. We love you, Melody. You're awesome. You're so sweet too. You're so knowledgeable. And you're an excellent writer, I have to say. Your Substacks is amazing. So I want to ask about the Fed. Okay, there's so much talk about the Fed. They had expectations that they were going to cut 7 times this year. Now it's 3. Who knows? Who knows what they're going to do? Inflation is entrenched. We know it's elevated. We're stuck in the 3s right now, and it's underrepresenting the CPI. We talk about the shadow inflation, the alternative. It's more than double. It's about 6%. If they cut, if they don't cut, it obviously affects the real estate market. Now, if they cut rates, they'll probably get the real estate market moving. It's not that the rates are so high right now, it's that compared to ZIRP, they are significant for people. We know the mortgage payments are like 3-4 times and property values are higher. What do you think could happen if the Fed decides to cut rates and prices are already elevated in some areas and they're not coming down as fast? What do you think could happen if that occurred?
Well, it's so interesting because in my industry, a lot of people talk about interest rates, but they don't understand them at all. And the bond market could decide it doesn't care what the Fed does in terms of cutting rates. And the mortgage rate, a lot of people don't know this, but it more closely tracks the 10-year Treasury, 7-year, because a typical mortgage is about 7 years on average because you refi or you do, whatever. Pay it off. So what we saw, for instance, at the beginning or the end of last year, beginning of this year, were those rates coming down before the Fed did anything,
Yes.
right? They just kind of said, meh, we're thinking about it, but they had already started to move a little bit. I think that, whatever they do, it does have an impact. It has an impact on those rates, but it's not going to be, unless they started buying mortgage backed securities again, you're not going to get rates low enough to truly change the dynamics in the housing market. Now, if the 10-year follows that 25 to 50 basis point cut, then you might get a little bit of refi activity, the same kind of activity we saw at the beginning of the year. But in 2010, we also had a refi boom. It did not change that overall narrative. I mean, our path of what was going to happen, because unfortunately in America, if they're going to give us the money, we take it, we spend it. We aren't usually very smart about it because we're always thinking about, and we're taught to think this way. Well, I'm going to get another job, or I just got another great job and it's going to be fine. Well, what happens if that you lose that job as well? And so I just think that it could delay things a tiny bit, but I don't think it's going to have a material impact. And if by some crazy chance, 300 basis points happens in Q1, which some people are thinking, then we're already in such dire straits. Like, there's not going to be people showing up to get, mortgages are showing up to buy homes at these prices. Because the other thing people often say is, well, the dry powder will come in. Well, dry powder is not going to pay these prices because if they can't get that return on investment, they're not going to do it. They're not going to waste their cash.
Interesting. Very interesting there. Yeah, I mean, absolutely. The rates are controlled by the bond market, and the Fed lowering rates is a concern for people, but they need to understand these parts of it. And it seems inevitable that something will happen. And at this point, it doesn't even seem that the Fed could even stop it, just like they can't stop inflation because they printed so much money, I think over 5 trillion during COVID. And when you increase the money supply, you have inflation, or debt to GDP is up 122%. But okay, speaking of debt, and that's the topic here, Ginnie Mae and Freddie Mac, I'm sure you're familiar with this new FHFA grant approval that they have for Freddie Mac to purchase up to $2.5 billion in second lien loans over an 18-month period. So now people are able to free up some equity in their homes and have more liquidity from taking on more debt. What are your thoughts on that? Is that another disaster in the making?
Yeah, I mean, I was very upset when I, saw the announcement, because for those of us that survived the last crisis, all you did was talk about on the street getting rid of your second liens. At my company, we sold them for 10 cents on the dollar. I mean, it was a bad word in the industry. until very recently. So to see that come out of Freddie Mac was just a little horrifying. And I talked a lot about it on various shows. But I think the way they put some of these guardrails on, the limits on it, it's going to be very interesting to see how it plays out. But I have a feeling that the people that need it the most are not going to qualify. And so I don't know that it's going to help anybody but those that already could get help somewhere else. And so that is where, we'll see what the impacts are. It is absolutely debt slavery to me. It is absolutely setting someone up for failure. It's absolutely about eroding your ability to purchase a home in the future. It's about even, impacts your job choices, because if you need to make a certain amount, then that means you get to be a slave to some corporate entity for the rest of your life just to pay that debt. And so to me, it's a terrible idea. It probably won't be as impactful as people have thought, like the Meredith Whitneys of the world. But it is a terrible idea. It's absolutely, it's a free market. But this is what bothers me. It's not a free market because it's the government that is doing this program, and they're actually competing against private. This is a big thing out of the industry because there is already a home equity market. And so, but what you're going to get now is you're going to get the government involved. You're going to get the non-banks because they don't have deposits. So they need this liquidity from Freddie to do it. But what this will likely open up is more lax underwriting. And that means more people in the debt trap.
Yes, economic slavery.
Correct.
And exactly, well said. Too much debt, over leveraging of debt, it's leads to ruin, unfortunately, and keeps us as slaves when ultimately we want freedom. So
Right.
thank you so much for this, Melody. Please tell us your motivation and passion, because you are certainly very passionate. And you expose the truth in real estate and what's really going on out there. And you have this special empathy for the forgotten America.
Yeah. So, I mean, unfortunately, it's through hardship, of course, that I've learned, that I've this empathy has been forged, because my parents growing up, they were impacted by inflation. They bought a house. My dad was a teacher. He believed he'd done everything he could possibly, that he'd be able to afford everything. It was going to be fine. And then with inflation, very soon he realized my mom was going to, they decided my mom would have to come back to work. And this is very much the story of the 80s, and go to work for the first time. And she goes to work. And in reality, neither of them were prepared for that. And it just, and at the same time, they were coming under more financial stress. And so, they'd bought into the American dream, but it wasn't working out. And ultimately kind of led to strife, divorce, and we lost our home to foreclosure. And, that was when I was very young. And the trajectory of my life, of my sister's lives, my parents' lives, was completely changed because of these macroeconomic factors that they simply just did not understand. And if they had known about how rates change, what could happen, they might have been able to make different decisions. But it is during these times, people just get brought in through these ideas of maybe easy money or things like that, and they get trapped, like you were just saying. And so, that's where my empathy really comes from, is from personal experience. And then, I helped manage default when I was at GMAC. And so seeing all of those lives being turned upside down, but also seeing a lot of fraud, made me realize that this was a very complicated market. And it becomes increasingly complicated when the government is involved at such a large scale.
Well, thank you so much for sharing that. Please tell our audience how they can follow you and read your amazing Substack.
Thank you. So the best place to get in touch with me the fastest is on X Twitter at M3_Melody, Melody. My Substack, M3 Melody Substack, and then YouTube, M3 Melody YouTube. That's I'm starting a new series. I think this is the first
Hmm.
podcast I'm talking about it, but on that channel, it's going to be called The Forgotten American. And it is going to be interviews with people that I meet on my travels, our
Oh,
followers, but regular Americans, people that aren't, this isn't our thing studying the economy. Because what I found when I was on the road is that those Americans were so much better at articulating it than most of FinTwit or this, financial media.
well, we're looking forward to watching that. There's nothing like getting the boots on the ground and the real sentiment of the Americans and what people are experiencing. So we appreciate you and thank you so much, Melody.
Thank you so much for having me. It's been a pleasure.